Okay, we are still accounting for investments, which means that we are using our cash to invest in something. In this situation, we're investing in the company's stock, and the difference in this one is that we are going to be acquiring greater than 20%, 35% of a company, which means that we can exert some control over it, which means that we have to use the equity method to account for this. So the equity method is different than the cost method. And it says that when we purchase this, we are going to debit our investment and credit cash for the amount that we purchase it for. But then what changes is that when the company has income, we're going to increase our investment for our share of that income. When they distribute dividends, we will decrease our investment for the dividends. All right, let's look and see how this works. So on January the 2nd, our company, Cole Company, acquired 35% of the outstanding stock of Toby Company. And they tell us the amount, so we can just put in $625,000, and we paid cash for our investment. We are investing our cash into a company. All right, again, because we have 35%, it tells me that we're going to use the equity method to account for this. So at the end of the year, when Toby Company has earned $110,000 of income, we need to use that to increase our investment account. And I made a note of it right here. So their portion of income, their total income, is $110,000. Our portion is 35%. So when we multiply, we find out that we need to increase our investment account for our portion, which is $38,500. All right, we're going to credit a revenue account called Income of Toby Company. Our portion of their income. All right, also on December the 31st, the company issued dividends. Dividends are distributions of their income. In other words, they distributed some of this. They didn't hold all of it. They distributed some of it to us. So what we'll do there is that we will say that we got the cash. We need to find out how much. They distributed dividends of $26,000, and we got 35% of that. So $9,100 is what we received in cash. And that $9,100 is going to reduce our investment. And again, that's because they distributed some of their earnings, so we need to reduce our investment for those earnings that we received from them. So this is how you will account for the investment of stock using the equity method. And we use the equity method because we acquired between 20 and 50% of ownership. So let me know if you have any questions.